Two companies. Almost the exact same revenue last year, about $250 billion each. One of them earned around $9 billion in operating profit. The other earned $109 billion. Same sales. 12 times the profit. So what's the difference? It's one number. And once you see it, you can't unsee it. I've spent 50 years reading income statements. And if I could only look at one line before judging a business, it wouldn't be revenue. Revenue is just noise. Anyone can sell a lot of stuff at a loss. The number I want is operating margin. It tells you how much of every dollar in sales actually survives the journey through the business. It separates the toll bridges from the treadmills. And by the end of this video, you'll read it the way I do. Because the third thing it reveals is the one most investors completely miss. Let's keep this simple. Operating margin is operating income divided by revenue. That's it. Say a company sells $100 of product. It pays for the product itself, the workers, the rent, the marketing, all the costs of actually running the business. Whatever's left over, that's operating income. If $20 is left, the operating margin is 20%. Here's why I love this number. It sits in the middle of the income statement, and that's the point. Gross margin only looks at the cost of the product. Net margin gets muddied by taxes, interest, and one-time charges. But operating margin? It's the cleanest look at the core engine. How good is this business at turning sales into profit before the accountants and the lenders get involved? A high operating margin usually means one thing: pricing power. The ability to charge more than it costs you year after year because customers don't have a better option. And pricing power is the closest thing to a moat you'll find on a spreadsheet. But a high number isn't always good news. And a low number isn't always bad. Let me show you why. Remember those two companies from the start? Let's name them. The one that earned around $9 billion was Costco. The one that earned about $109 billion was Microsoft. Both did roughly $250 billion in revenue in their 2024 fiscal years. Costco runs an operating margin of around 3 to 4%. Microsoft? Around 44%. That's a staggering gap. But here's the twist most people get wrong. Costco is still a phenomenal business. Costco chooses thin margins. It deliberately marks everything up just enough to keep the lights on, then makes its real money on membership fees. Low margin, enormous volume, fierce customer loyalty. It's a treadmill that runs incredibly fast. Microsoft is a toll bridge. Once it builds the software, selling one more copy costs almost nothing. So nearly every extra dollar of sales drops straight to profit. That's why its margin is 12 times higher on the same revenue. So the lesson isn't high margin good, low margin bad. The lesson is, you have to understand the business model behind the number. A 3% margin in retail can be excellent. A 3% margin for a software company would be a 5-alarm fire. And that brings me to the mistake that costs investors the most money. A single operating margin is a snapshot. But a business is a movie. The real signal is the direction. Let me give you a real one. Intel. For years, Intel was a fortress. In 2021, its operating margin was around 24%. Healthy. Dominant. The kind of number that lets investors sleep at night. Then competition arrived. Companies like AMD and TSMC started eating its lunch. And watch what happened to the margin. By 2022, it had collapsed to roughly 4%. The following year, parts of the business were losing money outright. The stock told the same story the income statement was screaming. A falling operating margin is often the first hard evidence that a moat is draining. Customers are leaving, or the company is being forced to cut prices to keep them. Either way, the engine is weakening. Now flip it around. A margin that's stable or slowly rising over 5 or 10 years? That's a business with durable pricing power. That's exactly the kind of quality Warren Buffett hunts for. It's why he loved See's Candies, a company that could raise prices nearly every year because people simply wanted that specific box of chocolates. So don't just ask, what's the margin? Ask, where is the margin heading? That single shift in thinking will keep you out of more value traps than almost anything else. Here's your 3-step checklist. Write it down. First, compare within the industry, never across. Stack a software company against software companies. A grocer against grocers. Comparing Microsoft to Costco on margin alone is meaningless. Second, pull up 5 to 10 years of operating margins. Is it stable? Rising? Or quietly eroding? Consistency is a sign of a moat. Volatility is a question you need to answer. Third, and this is the one that separates real investors from spreadsheet jockeys, ask why. Why is this margin high? Is it a genuine advantage, like a brand or a network, or is it a temporary boom that competition will erase? A high margin attracts rivals like blood in the water. The question is whether the business can defend it. Do this, and you'll spot quality businesses long before the crowd does. And just as importantly, you'll avoid the falling knives. A quick reminder, this is educational content, not financial advice. I'm naming these companies as examples to learn from, not stocks to go buy. Always do your own research. Here's the one principle to carry with you. Revenue tells you how big a business is. Operating margin tells you how good it is. A great company doesn't just sell a lot, it keeps a lot. And the businesses that keep more of every dollar, year after year, decade after decade, those are the ones that quietly compound fortunes while everyone else is chasing the next exciting story. The income statement is always talking. Operating margin is where it tells you the truth. So here's my question for you. What's one company you think has real pricing power, a business that could raise prices tomorrow and you'd still pay? Tell me in the comments. I read them. And if this changed how you'll look at an income statement, subscribe, we do this every single day. Tomorrow, we're breaking down a metric that fooled even some professional investors during the dot-com bubble. You won't want to miss it.